Financial red flags. 10 signs you're living beyond your means. Are you financially stable, or are you secretly drowning in expenses? Many people think they're doing fine financially until an unexpected bill or emergency reveals the truth. According to CNBC, over 60% of Americans live paycheck to paycheck, including some earning over $100,000 per year. So, what are the warning signs that you're living beyond your means? And how can you fix them before it's too late? Let's break it down. Sign number 1, you have little or no savings. If you don't have at least 3 to 6 months' worth of expenses saved, you're at risk of financial disaster if you lose your job or face an emergency. Bankrate reports that 57% of Americans can't cover a $1,000 emergency without borrowing money. How to fix it? Automate savings into a high-yield savings account. Start with just $25 to $50 per paycheck and build up over time. Cut non-essential expenses like unused subscriptions. Sign number 2, you rely on credit cards to cover necessities. Using credit cards to pay for groceries, rent, or utilities is a warning sign. If your debt grows every month, your income isn't covering your lifestyle. The average American carries $6,500 in credit card debt at 20% plus interest. How to fix it? Track your spending with budgeting apps like Mint. Cut unnecessary expenses to reduce reliance on credit. Focus on paying down high-interest debt first. Sign number 3, you're only making minimum payments on debt. Paying only the minimum amount on credit cards keeps you in debt for years. Example, if you owe $5,000 on a credit card with a 20% interest rate and only pay the minimum, it could take 10 plus years to pay off. How to fix it? Use the debt avalanche method. Pay off the highest interest debt first. Add even $50 extra per month to accelerate payments. Call your credit card company to negotiate a lower interest rate. Sign number 4, you have a high debt-to-income ratio. Your debt-to-income ratio, DTI, measures how much of your income goes to debt payments. A healthy DTI is below 36%. A DTI above 50% means half your income is going to debt, putting you at financial risk. How to fix it? Avoid financing unnecessary purchases. Focus on paying off debt before taking on new loans. Increase income through side hustles or career growth. Sign number 5, you can't afford to invest. If you're not investing, you're missing out on compound growth, which makes long-term wealth harder to achieve. According to Fidelity, those who start investing in their 20s can retire with double the wealth of those who start in their 30s or 40s. How to fix it? Start small. Invest $50 to $100 per month in an index fund. Contribute to an employer-matched 401k. It's free money. Cut unnecessary expenses to free up investment funds. Sign number 6, you're leasing cars you can't afford. Leasing a car means you never own it, and monthly payments drain your finances. The average car lease payment is $540 per month, yet financial experts recommend keeping total car costs under 15% of your income. How to fix it? Buy a used car instead of leasing. Pay cash for a vehicle if possible. Keep car payments below 15% of take-home pay. Sign number 7, you don't budget or track your spending. A 2023 U.S. Bank study found that only 41% of Americans use a budget. Those who do have higher savings and lower debt. How to fix it? Use budgeting apps like YNAB or Mint. Set spending limits for dining, shopping, and entertainment. Review your finances weekly to stay on track. Sign number 8, you keep up with lifestyle inflation. When your income increases, do your expenses increase too? This is called lifestyle inflation, and it's one of the biggest financial traps. Example, you get a $10,000 raise and immediately upgrade to a luxury apartment. Instead of saving or investing, all the extra money gets spent. How to fix it? Keep your living costs stable, even as income rises. Invest or save at least 50% of any raise. Prioritize financial goals over unnecessary upgrades. Sign number 9, you finance luxury purchases. If you're financing vacations, designer clothes, or high-end gadgets, you're likely overspending. A 2023 LendingTree survey found that 35% of Americans go into debt for vacations. How to fix it? Only buy luxury items if you can afford them in cash. Save up before major purchases instead of financing them. Use the 24-hour rule. Wait a day before making impulse purchases. Sign number 10, you ignore your credit score. Your credit score affects loan approvals, interest rates, and even job opportunities. A bad credit score, below 650, can mean difficulty getting approved for housing or car financing, increased insurance premiums. Fix it. Check your credit score for free at sites like Credit Karma. Pay all bills on time. Late payments hurt your score the most. Keep credit card balances below 30% of your credit limit. If you recognize any of these financial red flags, don't panic. The key is identifying the problem and taking small steps toward financial stability. Which of these red flags do you struggle with the most? Let me know in the comments. If you found this video helpful, be sure to like, subscribe, and turn on notifications for more personal finance tips.